All right, this is quick value number 265. Amrize is the company. This is the upcoming spinoff of the North American cement aggregates building supplies business from Holcim. I think the date is set, maybe not the date, but June 2025. So we've got an investor day, got a Form 10 filing, we got the spin ratio, we got all the details we need. And you can see the chart has been pretty strong here the last 2+ years. And then recently a little bit weaker as the market's been selling off. So stock looks pretty cheap based on the latest results. I'll get to that in a moment. First, two segments in this business. You've got a building materials segment and a building envelope segment. Building materials, let's see. That's your cement, aggregates, concrete, asphalt, etc. And they're a leading player in that cement business, and they're up there in the aggregates business. The envelope business is it's really like a roofing and walls company, so it's a pretty good comp to Beacon, BECN, which is being acquired at a pretty good multiple from Brad Jacobs' company QXO. So those are the two segments. And we've got a nice table of all the segment results. Building materials is much larger, 8.3 billion revenue, 2.5 billion EBITDA. Building envelope. This business is pretty new. Let's see if I can find the slide for it. Might be a little further back. They bought Firestone Building Products in 2021. So you've got a 3.4. Here it is. So here's all the stuff they do, right? The different areas and the different brands that they own. And the whole segment was created in 2021. So this is new. Here it is. Firestone Building Products, they bought that company in 2021. They've done 7 acquisitions since then to build this $3.4 billion segment. So this is really a fresh platform that they're creating inside this company that they've done inside of Holcim, actually. So the maybe the jury's still out, right? I haven't done the work to see how much they've spent on these 7 acquisitions, but I think that'd be a good exercise because that business is currently kicking off $770 million in EBITDA for 2024. So anyway, just something to keep an eye on. It's kind of a new business unit. All right. Segment or the overall financial results. We've got this beautiful 4-year summary table. I wish every spinoff would do this. This thing is amazing. So we've got the EBITDA calculation, all the adjustments going into it. These are pretty clean financials. I mean, there's not much in the way of adjustments to adjusted EBITDA. They give us the breakdown to the segment level. We've got margins here. Margins are good and trending higher. We've got cash flow data, net income, GAAP net income. We see free cash conversion to net income, 130 to 150%, which just doesn't sound right from an accounting standpoint, but that's really, really strong. And then 50% conversion of EBITDA into free cash dollars. So this is a really pretty high quality financial profile at first glance, right? So I wouldn't be shocked to see this thing trade at a premium multiple, given the revenue growth, the EBITDA growth, margin expansion, free cash conversion, etc. So anyway, that's kind of the backdrop of those two segments. You know, they've got leading positions in each segment. They're the largest. They're the largest cement company in terms of production capacity. I don't know about revenue. They tout production capacity, but not revenue. So they're a big player in the cement business. They're a big player in aggregates. The roofing business is pretty new. Thesis there. You got an aging supply of commercial buildings. 75% of them are 25 years old or 25 years or more in age. Price of cement's been solid. These are like pretty good, resilient businesses economic-wise. And, you know, you've got a lot of infrastructure spending. So there's a nice slide up here on the mix that I want to look at really quick. Yeah, so here's first the materials segment, 50% cement, 50% aggregates, and everything else. So that's kind of your mix of that segment. They probably should split it out into 3 segments, but whatever. All right. Here we go. I like this. Okay, so here's your mix between the two segments, revenue-wise. New construction, so new build, 56% of the business. Repair and remodel, 44%. Maybe that's your more stable, recurring revenue stream. And then your three end markets, if you will, 23% residential, 28% infrastructure, which probably has the strongest outlook of the three of those, and then commercial, 49%. Commercial's 49%. So pretty solid outlook. They're guiding to 5 to 8% revenue growth, 8 to 11% EBITDA growth, and continued 50% free cash conversion, which is pretty incredible. They didn't comment on the Investor Day presentation how much acquisitions will play into the revenue and EBITDA numbers. My guess is it'll be a lot. I think they've been acquisitive, and I've got a slide here in a minute. They've been acquisitive, and my guess is that's going to be like priority number one for capital allocation. So that's the outlook. Infrastructure spending, like I said, I think that's got the best outlook. Here's just a quick chart on the Architecture Billings Index. This is a good leading indicator for commercial new construction. It's been under 50 for a while now, so I don't know. I mean, I guess it makes the outlook maybe much more impressive if they're doing that in a time when commercial construction isn't that strong. So that's the outlook. So you got good, clean financial history. You got solid cash generation. You got a really impressive looking 4-year outlook. And then valuation wise, this is interesting. You've got peers. I pulled this a couple days ago, so it's maybe not recent as of today, but it's just a couple days old. You've got global cement peers trading at 12x earnings, 7x EBITDA. You've got the U.S. aggregates peers trading at 23 to 24 times earnings and 13x EBITDA. These are like really high multiple businesses on the aggregate side. And it looks like the cement businesses are kind of weak, but they're more global than this business will be. So I wouldn't be shocked to see Amrize trading at the higher end, like more like an aggregates business as opposed to this global cement peer group. So I don't know. We'll see. Maybe that'll make the stub RemainCo piece of Holcim that much more interesting. Building suppliers, I haven't shown those, but I think Beacon's getting bought out at like 11 or 12 times EBITDA or something. So this should come out at probably a big multiple, I would think. All right. 553 million shares out. Net debt, I've got just shy of 2.6 billion according to the Form 10. The Form 10, by the way, this is a good one. Like, they've got really good overview of the industry, indicators. I mean, they even talk about the indicators that they look at, which I think is pretty helpful. When they talk about the segments that they operate, maybe it's in the business section. You can see where the sections I like to look at. Business. This is pretty cool. I mean, they tell you like how the industry works. Here's key leading indicators, remain positive, well positioned, and they almost explain to you like how where is it? I gotta find this. Now, they have this really interesting background. I mean, if you're not familiar with how these businesses work, like in the aggregates business, what they do and how the product is made and sold and everything, I mean, they lay all that information out in a way that's pretty helpful. So anyway, this was a good Form 10. I'm not going to go too much deeper into it. I laid out a couple of valuation scenarios. I'll just go to my sheet. Here it is. Ignore this because we don't have a share price yet, but this is usually my like capital structure overview. This is my scratch math on RemainCo Holcim, but it's not yet complete, so ignore that too. All right, here's the 4-year free cash per share, net income per share. Free cash is way higher than net income, which just doesn't sound sustainable, but maybe they have that much deal amortization that it is. So here's a couple scenarios I laid out. Free cash, I just kept it at 50% of EBITDA, right? That's the formula there. EBITDA, I took 2024 and grew it by 10%, just assuming they continue down that path. And then that's at 2.58 billion on 553 million shares. So here you go. 12x to 20x free cash, you got $38 to $63 a share. 7 to 13x EBITDA, you got $40 to $78 a share. So I don't know. We'll see where this thing is indicated when issued, but my guesses will be 50 to 70, right? So like 16x earnings, 11x EBITDA, up to 23x earnings and 13x EBITDA. I think that's probably where this thing will come out. Probably wouldn't be all that interesting to me, but we'll see. Stranger things have happened, right? Stranger things have happened. So that's the scenario. Looks like a good company. Looks like it should get a premium valuation. The balance sheet's pretty clean, right? I mean, 2.58 billion of net debt on 3.5 billion. So I mean, they'll have capacity to go do stuff. Like they'll have capacity to go allocate capital right out of the gate. I mean, these guys will probably be pretty aggressive. And they didn't really talk that way on the call, but this is the thing that's interesting to me, right? So part one is what's valuation going to be post-spin. Part two is how's this deal thing going to work out for them? So this is just a chart inside of Holcim. So this is like pre-spin, right? Consolidated Holcim. This is cumulative acquisition spend by year, right? So you've got a company from 2013 to 2020, not really that acquisitive, not really. Then in 2021, the floodgates are open. I mean, look at this. Almost no deal activity, and then almost $10 billion spent on M&A from 21 to 24. And I think a big chunk of that was in this North American segment. So you've got a really dramatic change in capital allocation here over this time frame in a company that's getting very aggressive from an acquisition standpoint. So I think that's kind of a risk, right? Like, I mean, it's pretty early. They've been acquiring businesses at a time that's been shaky, right? With pandemic era results. They've come out okay so far. I mean, the segment financials are good, but I do think that's probably something to monitor. Yeah, here we go. So yeah, lots of acquisitions in here, and they've done, most of the deals are in aggregates and or the building envelope segment. And both of those have seen continued EBITDA growth. So I don't know. So far they've been good, but I think the jury's still out. I'd watch for that, right? There's the potential that this management team could get a little aggressive on the acquisition side and do some sloppy deals, but we'll see. I don't know. This is pretty indicative, though, of a dramatic change in capital allocation policy. So would love to get your thoughts. Waiting to see what this thing trades at once the spin comes out in June. Maybe I'll do an update post or comment or note once it starts trading. I'd probably get interested in like the $40 territory, but my guess is it'll be like 60 to 70. So I don't know. We'll see. If you've done work on it, share some thoughts. Check it out at valuedon'tlie.com.